accountants. So those wishing to avail themselves of this accreditation should send us an email on admin@mmf.org.mt unless you have already done so in the run-up to this event. Before closing and passing the floor to my chairman, I wish to thank all of you participants here today. We are around 200 registered participants. And I'd also like to thank, of course, my colleagues and partners at Bank of Valletta and Saxo Bank, with whom it is always a pleasure to collaborate on initiatives of this kind of value to our members. Thank you very much indeed. And I now hand over to Judge Emeritus Joseph Zamit McKeon, who has taken over the chairmanship of the MMF from Dr. Joe Borge only a few days ago, in fact, on the 12th of May. Thank you very much. Over to you, Mr. Chairman.
Dear participants, guest speaker, friends, and colleagues, it is indeed my pleasure to address you today in this first event for me in my new capacity as chairman of the Malta Maritime Forum, a position I am so proudly taking over from Forum's first chairman and Malta's ever first EU Commissioner, Dr. Joe Borge. At the outset of today's proceedings, I must thank Bank of Valletta, our prime supporter, as a forum for standing full square behind this organization, which brings together all the stakeholders, both public and private, involved in the Maltese maritime industry, which is of vital strategic and economic importance to this country. The pandemic we continue to endure has proved the importance of the trade, shipping, and logistic links we all depend on for the procurement of food, medicine, and other commodities which we require. Malta's contribution to the global maritime trade and tourism links are what we are discussing today, with the support of Bank of Valletta and Saxo Bank. So once again, I thank these two banking institutions and their teams for making this event possible for the benefit of our members. The pandemic has taken its toll on all aspects of the logistic world. Perhaps with the exception of the cruise liner business, the rest of the industry has had to plod on with all the health risks involved to all seafarers and frontliners in this business. In the midst of this unprecedented negative global environment, which, besides COVID, is also characterized by extraordinary factors on the political and environmental levels, just to mention two, we certainly look forward to the valuable opinions of our distinguished keynote speaker and Saxo Bank Chief Economist, Mr. Steen Jacobsen, on the immediate and medium-term world economic outlook. Our members present here today are particularly interested in Mr. Jacobsen's assessment and forecasts on global business trends, which would, of course, impact Malta's maritime industry to the extent that a proportion of global trade passes through Malta via transshipment, ship agencies, and other services, including legal and financial. The advices of Mr. Jacobsen and our distinguished panelists today will be crucial to our members in their plans and decisions relating to strategy, management, and investment. Of course, investment made in one aspect of the industry, say new buildings, needs to be matched by others, such as local port operators, as we have seen with recent 20 million euro investment in new German technology key cranes undertaken by the Malta Freeport, held on the heels of CMA GCGM's investment in super container ships, powered by liquefied natural gas, due to the capability of these mega-max cranes to stack rows of 11 container high onto these vessels of gigantic proportions. In the past, in fact, the French Container Shipping Group announced an order of 22 vessels ranging in size and fuel type. Other shifts and changes in global trends are bound to affect the industry in many ways, such as demand for ship repair, price of fuels and freight rates, just to mention an obvious few. These are merely some preliminary thoughts from my end to start off but I am more than confident that we will be developing other more complex issues as we go along. The forum is constantly in touch with its local and international network of experts to keep tabs on the latest developments with a view to make the necessary presentations on behalf of the industry and inform members accordingly. We are currently participating in talks relating to decarbonization in the wider concept of climate change with the Foundation for Transport in Malta and the European Network of Maritime Clusters, in which we are actively affiliated. Upon the invitation of Bank of Valletta, we are also keeping an open dialogue with Malta's banking sector to obtain a better mutual understanding of issues relating to financial risk mitigation. Further still, and much closer to home, we also made successful public calls for workers in our industry to be fast-tracked within the COVID-19 vaccination program, and we are also keeping a close watch on the Grand Harbour regeneration plan. In this regard, we seek to encourage the authorities to execute the necessary competitiveness enhancing investment within a holistic plan, a plan which needs to be in harmony with our operations and which at the same time dovetails the progress in the maritime industry. For the moment, I stop here and pass on the word to Kevin to introduce our esteemed keynote speaker.
Thank you, Mr. Chairman. So a brief word of introduction, although I am sure many of you have read Mr. Jacobsen's impressive CV. Just a brief word of introduction. From me, suffice to mention that Mr. Jacobsen has more than 30 years of experience within the fields of trading and investment, and he is a highly renowned and respected chief economist who regularly appears as a guest host on CNBC and Bloomberg News. Prior to joining Saxo Bank, he worked with Swiss Bank Corp, Citibank, Chase Manhattan, and UBS. He has also served as global head of trading, FX, options, and Christiania. Before giving him the floor, a small word of warning from my end. Mr. Jacobsen is the founder and spearhead of Saxo Bank's renowned Outrageous Predictions, and his approach to trading and investment is thought-provoking, and he is not afraid to counter consensus. This frequently sparks debate amongst the global market community, so we look forward to questions and comments from the audience during question time. Mr. Jacobsen, over to you.
Mr. Chairman, Kevin, thank you for that introduction. I guess what you essentially said is that I never had a real job, which is pretty close to the truth, to be honest. It's a pleasure, dear members of the Malta Maritime Forum. I know normally we are having my colleague, Mr. Christopher Dembik, a Frenchman, coming to you and doing these introductions and speeches. But it seems like this year we need to be serious, so we are sending in the Vikings, but of course also the Vikings who have a deeper root in maritime history than they have in France. So take that as a compliment that we are doing that. And very much today I will actually talk to the world as we see it today. Let me just start the broadcast here. As you just heard, over 30 years in this business. I still don't know how to start the broadcast. It should be all right. Apparently, it tells me. Okay, and then I go to my screen, and let me know if you can't see the presentation. So, what I want to start by saying is pretty simple, and it is that. What is interesting in the post-COVID-19 world is that the physical world is simply too small for the aspiration of both the political spectrum, but certainly also the aspirations of green transformation, infrastructure, and the support of the inequality and reducing the inequality in the world. So the way we see that very quickly, of course, is the container rates, it's the shipping rates, it's the increase in timber prices when you go to do some house improvement and the likes. But in my opinion, that is only the beginning. So the number one conclusion is, number one, we've had a structural change in the way we conduct economic policy. So in 2008, 2009, many economists, including myself, did the mistake of thinking that a QE program, printing money, would lead to inflation. What we can say right now is that, of course, taught from history, we know absolutely nothing about inflation. But what is interesting is that the new crowd of politicians, the new financial and economic theory of MMT, modern monetary theory, they claim that they understand inflation. If you cannot see that sort of inadequate way of looking at the world, then we have an issue. But basically, let me tell how the world has changed. Number one, the central banks and the politicians are aligned on fighting inequality, which means that the way we do policy responses in the world today is employment-centric and results-centric. So instead of before, where we have a communication from central banks that they think that this and that was going to happen, now we have a tangible target, full employment, as an output that we measure up against. Meaning that in any complicated model or any complex model, you basically have one output and the rest is viable. And the variable way we can do that is basically that everyone has now accepted that inflation is not and no longer part of the central bank's remit. If you listen to Powell, if you certainly listen to Mrs. Yellen, if you look to the Reserve Bank of Australia, if you look to Ms. Lagarde, they're all focused on getting the economy back to full employment, which I find kind of ironic, considering that, the slowdown in the world economy that we saw in February, March was not a recession in a true economic sense. It was a binary closing down the economy and then opening it up ever so slowly. But it was not a classic sort of recession environment. But let's start from 20,000 feet. What the policymakers and the central banks is trying to do simultaneously, and simultaneously being the key word here, is to solve for three generational challenges: fighting inequality, creating this employment-centric sort of policy, doing green transformation. And as the chairman rightly said, if you want to decarbonize, you are metallizing, if that's even a word, but you are basically putting a huge amount of pressure on a sector that's been underinvested into for at least 20 years, if not 30 years, a sector which, generally speaking, is considered not to be ESG compliant, a sector where people who sit on the boards of these mining and natural resource companies are livid, afraid of getting sued for environmental impact on the decisions that's been taken in the history of these companies. And finally, we are saying that we need to rebuild the infrastructure that we have under-invested into over decades. And in the middle, I put, just to put some context to this, in the US, we talk about spending, and people are basically saying this is a big amount of money, $1 to $3 trillion worth of money over 8 to 10 years. But look at these 4 independent reports from OECD, Bhattacharya, from McKinsey and NCE. They put the annual need in terms of infrastructure, just to keep the infrastructure in place, at between 3.3 and $8 trillion a year. Not over 8 years, not over 10 years, but every single year. So in order to get the infrastructure back, we need to move to a new model. And that model, of course, is that we need to see governments, and governments will have a larger part of the economy. Lesson number 1 from 30 years of doing this job: when the government gets involved, the minimum result of that is that you'll see increased regulation. Because what the governments will always say is that, yeah, we will help the Maltese maritime businesses, but in order to dole out some money, we will need some control on how the money is spent. Not on reasonable demand, but the problem is it creates additional red tape. On top of that, we also see that the countries that traditionally has been very frugal, like Germany, Germany's been running what they in German call Schuldenbremsen, or a debt brake, for years and years. Now we look at a German election on the 26th of September, where potentially the Green Party will become the largest party in Germany. Inevitable, whether they become the biggest or not party in Germany, they will be part of the coalition. And that coalition will spend more money than Germany has spent over the last 20 years. Germany last year spent 25% of GDP in direct and indirect support of businesses and jobs and the likes. So you've seen the most frugal turn spending. You have seen a combination of monetary policy combining up with the fiscal policy, creating what we call a fiscal dominance. And the result has been immediate, as you can see from these headlines. Companies should shift from just in time to just in case. Everywhere you look, there is a supply chain mess. EU now thinks about strategically reducing its dependency on China in its supply chains. Australia is doing the same, the US is doing the same, and China is doing the same. So what we have right now is a system, again, back to my number one premise, that the physical world is too small for the actual aspiration and hope and the way we conduct our business. You can even argue that if we all get so digitalized as every single board around the world is trying to be right now, we simply have enough. We simply don't have enough supply coming out of the pipeline in terms of investment and the elasticity of that supply to actually meet the demand. Hence, we have had and we will have continue bottlenecks in the supply chain. We will also see significant inflation. And of course, close to the heart of you in Malta is the shipping industry. And this is just a remarkable chart. The way to read it basically is that the dark blue, the blue line, the blue area below is the average over the last 5 years versus the black line is where we are in 2021. And if you look at the middle one, Shanghai to Rotterdam, look at the levels that we're talking about. The normal rate would be around $2,000 per 40 feet container. Now we're trading at $9,000. And by the way, back in December, everyone told us by now that this overhang, this lack of supply would have been sorted. Instead, we continue to see higher freight rates, not only in containers, we see it in bulk, we see it in LNG ships that are being closed on 5 and 10 years contracts. It's potentially one of the best years we've had ever not ever, but in recent history in the shipping industry, simply because, again, the shipping industry is one where we have seen significant under capacity being available as the market has changed. And when we talk about availability in terms of what is happening to the global trade, we have had less globalization, but we have more items being bought out of China, being forwarded in terms of the production in Asia. And of course, we don't have the capacity, partly due to COVID-19, partly due to the sanitation of these containers and the likes. But overall, it's not just containers. The whole shipping industry is showing us that the marginal cost of long haul transport is up. Similarly, the short haul cost is also up. If you look at UPS, for instance, they cannot secure enough vans to do the last mile delivery on all the packages you yourself, but certainly your family is getting on a daily basis. So significant pipeline issues. And let's just select one thing, which is on top of the list for a huge amount of governments around the world. This concept of helping the CO2 reduction by moving to an electric vehicle supply and demand from the sector. On the left-hand side, you see an estimation of how much additional increase in production you need to see just to meet the right now targeted amount of the electric vehicle in the world. It would mean that nickel has to go up by 14 times, aluminium have to go up by 14 times, phosphorus, iron, you see the whole list. And on the right-hand side, you see an estimation on the year per year growth that needs to happen in the mining in order to keep up. In other words, the more green, the more inequality we reduce, the more infrastructure that we invest to, these supply and demand gaps will get ever bigger. And if we look at something else, which is a geopolitical risk inside the supply chain, I've taken on the left-hand side the German supply chain, where you see that manufacturing companies in Germany reporting shortage of intermediate goods is very close to 50%. Below, you see how complicated the semiconductor industry is in itself. You have the foundries, the production, you have the semiconductors, the tier one suppliers, and ultimately the vehicle OEMs. Huge amount of parts, huge amount of complexity, and every single kind in Germany needs a very simple semiconductor to in very often, which needs to be binary on and off, but these are not available. And if you look at then on who is actually producing these chips, 63% of all semiconductors is produced in Taiwan. Taiwan, which has been declared by China that it needs to be Chinese before 2049, a area which geopolitically is at risk every single day. So what we are building here is, again, to sum some of it up, we have too much physical demand relative to both the elasticity and the supply that we can have in the economy. The three generational aspiration that we're talking about, green transformation, fighting social injustice / inequality, and then ultimately infrastructure, all will add to the deficiencies that we see in the global supply chain and in the global demand and supply in terms of the actual resources due to underinvestment and the inability to do so. And what is then happening at the time where the government is pulling ahead and supporting what we call the lower K, or the people who has been hit the hardest by the COVID-19, is that the disposable income in the US and around the world has moved up significantly. We have, to some extent, already reached a universal basic income in terms of people in work who are being subsidized by the state. This has meant a huge amount of increase in disposable income. And what you see here is in the US retailers, the inventory to sales ratio, the lowest ever. Basically, they have nothing in the inventory. They are getting shipments delayed because of all we talked about, and they have a pricing power, which is going to end up in an inflation signal. So last week we had an inflation number, which the central banks likes to call transitory. But look at the lower chart here, which is the median inflation expectation in a University of Michigan survey, which is, for the record, what Fed uses for long-term anchoring on inflation. If you look 12 months out, the average consumer expect a 4.6% inflation against an average right now that sits barely about 2%. And it's important for me to point out that one of the challenges that we will have as business people is the very same inflation. I'm sure most of you will be able to pass on some of that inflation increases that we see, but you will also have an increase in the marginal cost of capital coming from the same rise in inflation. So this is something to look out for. This is what is also missing in the overall piece. And the reason why commodity is such a big driver is many things. As I said, underinvestment and the inability to actually ship it. The fact that Australia probably is going to be closed down in terms of exporting both coal and iron ore to China. But it's also the fact that commodities right now is actually a positive carry. And for someone who takes position in the market, I will right now in a diversified basket of commodities gets a carry rate of 5%, which for the record is higher than the equity premium in equity. So there is a self-fulfilling prophecy on top of all the supply and demand efficiencies that we see that the market will have to and can go higher. And then, of course, the travel industry, I know, is very important for Malta. And I had a quick look, and a company called Skiff has a recovery index. As you can see here in the left-hand side, this is the recovery in the US. We are seeing that certainly travel is coming back, but in particularly rental cars and other services coming through. So rest assured, I think that business travel will be back to 80% of what we used to be 100%. And I think tourist travel will be 120% of what used to be 100%. It's actually also, as you can see on the right-hand side, being reflected in the basket of stocks that sits inside the travel industry. As you can see from this chart, travel year-to-date is up 13%, which compares favorably, very favorably to other baskets that we have. But I guess, again, note the commodity sector being off 24%. So trying to close all of these themes off together, we have fiscal dominance. And this is the first time since the 1970s. And as you can see from the leg of hair I was around in the 1970s. If you want to understand how difficult it is to be a businessman under stagflation environment, just read Warren Buffett's investor reports from the 1970s. But what will happen is that the economy will be run hot and inflation will be running hot. The catalyst for this is that they're trying to fight inequality, infrastructure, and green transformation, but they're going to make it worse simply by enforcing three generational challenges into one exercise. We have a very high rate sensitivity, meaning basically that because we are so low in overall interest rate, very small changes to that interest rate will have a massive impact in terms of the pricing of bonds. And as we talk today, just for the record, German 10-year bonds is very, very close to 0%. 30-year German bonds is already at 60 basis point. Italian BTPs is now back at 110 basis point. So although it feels like the market is moving at a very slow pace, the absolute price that we pay in terms of market cost of capital is following the inflation higher. And of course, the geopolitical risk I just talked about. So what I think is unique and why I'm so excited right now is that we have a new social paradigm. I think, to be honest, and I'm an old guy and I'm not a very social guy, but I think meet, greet, travel, and talk and connect offline is going to be massively what people wants to do. I do not believe for one day that people are going to be working at home 5 days a week. There may be, individuals, but I think it will impact, as I said before, less than 20%. So people will be coming back. People will be coming to Malta. People will go into Malta to look to do business projects left, right, and center. The new policy we have in place and the policy response is basically to redistribute through government pet projects. And the problem, and I have to admit, I'm a libertarian economist, obviously, but pet projects means that it's a misallocation of capital. It has very good intention, but as I said, it's very, very difficult to manage in terms of the supply and demand. New reality, inflation is here. I mean, forget anyone who tells you it's not here. I think as business people, you clearly see it on a daily basis. And for the record, the CPI, the consumer price index does not measure inflation. It is one of the biggest forward economic sentiment indicators that's ever been made. And finally, I think the next 5 to 10 years is going to be the most exciting in my lifetime. And trust me, I've been around since the stock crash in 1987, every single crisis. But I actually do think, and this is my ending note, that this is the end of pretended extent. Pretended and extent is the fact that thinking creating more debt, keeping low interest rates solves anything. I think the fact that we're getting inflation means that governments will be forced to take a choice and a priority. I think what the vaccine lesson has taught us is that when we cooperate across borders scientifically, we can reach a new, better level, in this case for healthcare. How about we do the same for energy, which is the world is so dependent on? So let me close by saying that I am the most optimistic I've ever been in my 30 years of doing this job for one reason only. I don't think it could be any worse than it was in 2020. Thank you.
Thank you. Thank you, Mr. Jacobsen. Thank you very much for that very enlightening presentation. Thank you also for your positive outlook. Very, very good for us to hear at our end with our business community in the maritime industry here. Of course, inflation for us gets our alarm bells ringing in our heads because we are an island and we depend obviously on importation and exportation of goods and services. That's why we thrive in the maritime industry. But that puts us into a big risk of importing inflation, and the double whammy of that is, as you mentioned, the rise in freight rates. So we have to get over that as a country, but we have overcome plenty of challenges in the past, and we remain ever so confident as a nation of overcoming anything that gets thrown at us. Without any further ado, I'd like to give the floor now to Mark Shikluna Bartoli, who will be moderating the panel discussion. So over to you, Mark, and introduce our participants, please. Thank you very much.
Thank you, Kevin. Since we're running a little bit late, I'll jump into the questions and give short introductions on each member I will engage with, if that's fine, because we're running quite tight. I'll hop on to Steen. On the supply chain space, you gave a good insight on particularly geopolitical risks coming along, and even potentially the pressures on large corporates which need to green their supply chain going forward. Is nearshoring the future?
I very much think so. I think 3D printing, even 4D printing, apparently is coming and will change. But what is really changing short term is that government has started to think strategically. And in particularly China right now is importing more than they use in terms of iron ore and coal, because they have designed a plan that by 2060, they want to be CO2 neutral. If you want to be 2060 CO2 neutral, you need to be doing solar panels, you need to be batteries. So every single government, in my opinion, and in an average year, I travel to 40 countries. They're all doing the same thing. I'm sure you in Malta as well is having, considerable thinking about how you strategically can reduce your reliance on the rest of the world. And as you saw from the overhead, EU wants to be less dependent on China. China wants to be less dependent on the US. US wants to run its own self-reliance policy. So the quick answer is absolutely, nearshoring is going to be a bigger issue. But nearshoring, as you very well know, it does.
I think
yes, Steen has lost Steen. I think the other.
I'm here again. Sorry, it seems like the connection lost.
Yeah, there was a short connection, a short blip on the nearshoring piece.
But basically, you're right. Nearshoring, strategic thinking in terms of how people will do it is going to happen. But a lot of it will be inflationary, because if you want to be self-dependent in everything from sanitizers to semiconductors, that is a huge investment in terms of CapEx, but it's also a marginal increase in the cost. Because remember, nearshoring and strategic thinking in terms of resource global supply chain, it's really about deglobalization. So we stopped globalizing basically 5 years ago, and we have been reversing from that. And now we have, in my opinion, accelerated it towards this self-reliance positive cycle, which in itself is massively expensive, because we are not doing things just in time, which we used to do during globalization. We're doing just in case, which means that we're going to have more things sitting in inventory. We're going to buy more than we theoretically need and the like. So absolutely good thinking.
Interesting. I move to our next panel member, Thomas. Thomas has a good insight into the shipping industry. And I think when we all saw what happened in the Suez Canal, and everyone perfectly understood what kind of size of ships are actually connecting us to Asia. With Steen's analysis of more nearshoring, are ships actually going to grow bigger, Thomas, or is there a trend where they might need to start to get smaller? I'd love your thoughts on how the shipping industry sort of in the future will be looking like.
Well, hi, first of all, good afternoon, everyone. Thank you very much for inviting me for this webinar. Well, looking at new builds in the shipbuilding world, it seems like ship owners are going for larger ships, for mega ships. Both, whether it's containers, whether it's oil tankers, whether it's bulk carriers which carry grains. So it seems like, we're going towards mega ships rather than smaller ships due to economies of scale. As Steen mentioned earlier, there've been an increase in freight rates, but that's due to the COVID-19 surge, sort of the panic buying which is happening through Asia. But I don't think that would derail ship owners from, ordering larger vessels. This incident we had in the Suez Canal, which was very unfortunate, did teach us a few lessons, that's for sure. It did teach us how important first of all, the Suez Canal is to the rest of the world. I mean, just to give you a figure, up to 50 ships per day pass through the Suez Canal, and we are talking of around $9 billion worth of goods, and that's every single day. So that's how important it is. I don't think we'll be seeing ship owners go for smaller vessels. Actually, it will be the opposite. Ports will have to increase their infrastructure to cater for larger vessels. The smaller ports were affected drastically when this incident happened, because obviously they could cater for smaller vessels. But ports like Malta, Rotterdam, the big hubs, Antwerp, are all catering for larger vessels. I mean, Malta recently had one of the largest vessels in the world, I believe the CMA CGM Marco Polo. So the trend is going towards larger vessels. I don't see, shipping lines or ship owners going towards smaller vessels. It doesn't make sense.
Thanks, Tom, for that. It's good to know, although coming near shoring, you're going to have a lot more interconnection between ports. And that's why I asked the question, sort of, could there be a bit of a mismatch in the future where you have near shoring, smaller ports, more interconnected with a ship fleet, which is so large that the ports must not have accommodated, which could maybe create some logistical issues. We'd have to see. But
yes.
Thanks for your insights on that, Tom.
Thank you.
If I could move to Stephen Schwirep, who has a very good insight into the maritime, but from a cruise industry point of view. I'd wish your insights going forward, Stephen. Obviously, we all know the tourism industry has been hit pretty hard. The cruise liner industry was no exception. There's incredible amount of pressure on the industry to green the way it offers its services, and it's quite a challenge. Can the cruise liner match these two demands, presenting a more sustainable business offering to their customers, whilst at the same time coming out of this very, very difficult crunch time? I'd love your insights on this going forward. Steve.
First of all, thanks for the invite. And just to add to what Thomas is saying, that the cruise industry is also going bigger. I mean, just to give an example, in 2011, on board 313 calls, we handled 550,000 passengers. And in 2018, with 322 calls, which was just 10 more calls than 2011, we handled in excess of 700,000 passengers. So that explains that, you know, the industry is going larger as well. Of course, there's the economies of scales. There is, on sustainability, there is a commitment by the cruise industry at large to reduce emissions and to reduce also other, you know, to be more efficient by 40% by 2030. So this is a commitment by CLIA members, the Association of the Cruise Lines themselves, to reduce carbon emissions by 40% by 2030 by 2018. And there are four areas that they're looking at. Is the wastewater treatment, how to treat grey water, controlling emissions. This is being done in two ways. There's new builds who will be powered by LNG, and there is also the retrofitting of existing vessels with what we call exhaust gas emissions controls, which are commonly known as scrubbers. There's fuel efficiency, and also there is recycling, because after all, cruise ships are floating hotels. So these are all measures that are being taken by the industry at large. We as Global Ports, and of course Valletta Cruise Port as a member of Global Ports, and I as the CEO of Global Ports, I'm responsible for 19 cruise ports across 13 countries. We took part in a Green Ports initiatives where we're looking at also our terminal facilities in order to try and go green. We're looking at being more sustainable in ports, and we are supporting initiatives like, for example, the one by the government of Malta on the shore-to-ship supply. And this will, of course, aid the local communities. And it's not just about, you know, contributing to the environmental aspect, but also to the local economy. In fact, I had prepared some slides, but for the interest of time, I didn't want to use this, but I'm just using one particular slide, and I'm not sure if you're seeing it. The cruise industry contributed 83 million in 2019 towards the local economy. And 31 million of that is expenditure by the cruise passengers, and 52 million is expenditure by the cruise lines themselves. So this is the economic benefit for the country. So there are a number of initiatives being undertaken in terms of sustainability, but sustainability is not only at sea, but also on shore. And we as global ports are embarking on developing an app, what we're calling the Genie, which we want to introduce in ports and encourage cruise passengers to subscribe to. But the idea is with this app is not only to help passengers with their during the day in order to know where to go, etc. But this will give us an insight of where the passengers are going, so that in the future we can also try and channel passengers to different places at different times. We don't want, for example, in Malta, if we have 2 cruise ships with 10,000, 12,000 passengers, 80% of them going to St. George's Cathedral at the same time, because first of all, it's not sustainable for the cathedral. And secondly, it impacts the experience of the passenger. So we want to spread this experience. So we're looking at also these initiatives in order to make it more sustainable.
Thanks, Stephen, for those insights. I see concurrence on the size of ships. I think it may be an argument that the bigger the ship, the lower the environmental impact, because the larger number of tourists per ship. I think it might be an argument we may want to present from a greening perspective, but thanks for your insights on that. I pass on to Matthew from the investment side, wealth management side of Bank of Valletta. Matt, we're seeing the idea of nearshoring, we're seeing the greening of the economy, we're seeing a lot of trends that are coming along. Could we get some of your insights of how, as an investor, we could maneuver all these changes going forward? Sort of where would your feeling be to sit? I mean, seeing nickel go up by 14 times seems to be a little bit of a no-brainer, but maybe on a wider scale, I was thinking.
So first of all, thank you all for hosting me. Good afternoon. So with regards to the question, first of all, we have to notice one thing that's quite unique is that these themes, we've got supply chain, maritime transport, green tourism, they're quite disparate. They're very different from one another. And if we think back to a little bit of over a year ago, we were facing completely different themes. We were facing things like the trade war between US and China and a lot of different trends. So what I would like to focus on is maybe a little more esoteric, so to speak. So what I'd like to focus on is the importance of 2 principles in dealing with all the different changes. Because if we focus on principles on how to act in the world, then we can deal with all the different changes, not just these 3, but the inevitable new themes that will come within 2 months, 3 months, 6 months, 1 year, whatever. So it's clear that we need to focus on adaptability, right? And if we mention things like just in time versus just in case, those are 2 specific examples of what it means to be adaptable in the world. On the other hand, besides adaptability, we need the principle of vigilance, I think. And investors kind of go on the opposite way. We refer to something called complacency. So complacency is you being nonchalant about the risks. Vigilance is the opposite. It's being aware, if not hyper aware, of the risks. So with regards to adaptability, when we're talking about, for example, supply chains, we're talking about, do we want to have multiple sources of supply chains? For example, do we want suppliers to come from China, Vietnam, but also, for example, from Latin America or from other parts of Asia? Or do we want it from a single supplier? On the one hand, having one single supplier is good, obviously, for efficient reasons. You can negotiate lower prices if you have a single supplier. If you have multiple suppliers, it's hard. But that's where the just in case rationale comes in, because if one part fails, at least you have the redundant parts. And just to give you an idea how how important this principle is. It's a principle that nature itself uses. So this is why we have, for example, 2 kidneys. It's because just in case one fails, we still have another one, right? It would be more efficient for us to have a single kidney, for example, but we have 2 because nature thinks we should have this just in case. With regards to technology, what we have to notice is that we mentioned prices and prices going up and prices going down. You mentioned nickel. When prices change, incentives for producers change. So for example, let me mention lithium. A few months ago, there was a whole furore on lithium because people were anticipating increased smartphone sales, EV, electric vehicle sales. And so demand for lithium batteries went up. But what investors and what people in general don't focus on is they only see lithium. What they fail to see is that technology adapts. So for example, we got competing technologies to lithium. So for example, oxygen-based batteries, right? These things emerge out of the situations that prices increase. And inflation is a very hot topic, but it's incredibly complicated. And not all products are going to be affected in the same way. And it's going to change the structure of the economies, basically. And people are going to respond in different ways. So it's going to be extremely difficult to navigate. So this is why we need adaptability as a principle. And also, finally, we need vigilance. So vigilance is basically our awareness of the risks that we are taking. Now, in the investment world, we mentioned, for example, the bond and how low the yields are right now. Yields are low across the board, even when we look at investment grade bonds, even if we look at what are called high yield bonds or non-investment grade, or if you want to use the more colloquial term, junk bonds. We're earning extremely low interest rates on these very high risk assets. That is just a signal that investors, probably driven by central banks, are forced to be complacent. We don't have a choice in the matter. And Suez Canal, for example, that's another example. We need to be vigilant about container sizes, about shipping sizes, right? So we need to be aware of the risks. And we were speaking about ships getting larger and larger. That on the one hand is good because it's more efficient, but in case things go wrong, let's say, you're also exposing yourself to a big risk, because if you don't need to use a ship, all of a sudden you have a huge ship, which is basically unusable, versus if you invest in smaller ships, you might need to use less smaller ships. So in a way, you're less worse off, kind of. So just, if I could just leave those 2 things, it's adaptability and vigilance against these adverse scenarios.
Thanks, Matt. So I won't jump onto nickel, is the signal. I need to be careful of the adaptability of the market to question Steen's forecast. Well, it wasn't Steen's, I think it was Bloomberg, of a 14 multiple. I'm not seeing any questions in the chat. Aware of time, and I know Stephen is also pressed with a hard deadline. Let me just
there are no questions from our end. There are no questions from our end, but sorry.
Okay. I'll wrap up with maybe one question, common question to all speakers. They're not particularly sectors, and it was interesting to hear Steen's analysis that tourism, his feeling is that it would rebound pretty fast. Which sectors, in your view, are likely mostly to recover quicker? So if we were to say trade, transportation, tourism, just your views. We go around, each one of us, maybe starting with Stephen, because I know he has a hard deadline, and then moving on.
Well, I don't think that trade really stopped now. The demand for trade has remained there. I mean, looking at my business, I think the cruise business will recover once the tourism industry starts to recover as well. We've already started, but of course we're having hiccups because of the different measures being undertaken by different countries. And the cruising model depends on having an itinerary made up of a number of countries and number of ports. So unless the situation improves overall, for example, let's look at in our region, in the Mediterranean, it's going to take a bit longer to see the traditional cruising. So we're looking at new types of models now. We're looking at blue cruises, which are cruises to nowhere. And this is happening in the UK or in Germany and in Asia. And there are what we're calling also bubble cruising, like, for example, we're experiencing currently with MSC, where the experience of the guest is controlled from embarkation to disembarkation. Basically, they ensure that the guests have been tested prior to boarding, keeping them together, taking them on excursions without touching the local community, or else if they're stopping them to visit a particular place, they're actually, what we're doing in Malta is that the tour guides, the bus drivers, and even the people where they're going, they're being tested beforehand in the same morning. So it's a new reality. And I think the vaccination has a big role to play in order to return to some form of normality. I think 2021 is a stepping year. It's a new beginning. And hopefully in 2022, we'll see a bit more of a normal year. Thank you.
Thanks, Stephen, for the insights, and we much appreciate your time and your busy schedule. Thank you very much for joining us. Who's next? Thomas, would you like to give us your insights?
Yes. No, I think really and truly I agree with Stephen. I'm sure. As such, trade, we remain trading, even during COVID-19 times, even during the COVID-19 restrictions. Obviously, demand did increase when, we had this sudden burst of COVID infections and lockdowns and the rest of it. But it has gradually recovered. We're not at the levels we were before. I think there's more of a surge at the moment in demand. I think that demand will come down, and it will come down to a normal level again, especially with consumer goods. When it comes to, for example, fuels, demand for fuels such as jet fuels on airplanes and fuels for cruise liners, because there's another side to demand in trade and shipping, that will definitely recover. I mean, during the summer period, maybe when airports open again, cruise terminals open again, we'll see a surge. I think there'll be a quick surge in demand, and there will be a big recovery. I think very much I think trade in general, when it comes to shipping holistically, I think we'll see a quick recovery. I don't see it lagging for a long time, because ships remained moving. It's not like sort of the hotel business where things were shut down and nothing was functioning. So shipping companies kept maintenance up, they kept the employees. So I think we're going to recover sooner than later in the shipping industry. Thanks
a lot, Thomas, for your insights. Matthew and Steen, could I add another dimension to the recovery as well, if I may, to both of you, from a macroeconomic perspective? Obviously, Steen was clear, inflation is here. How do you see the recovery in the context of upcoming inflation? How do you see it will affect these three different areas? Start with you, Matthew, and we'll conclude with you, Steen, if that's fine.
So, yeah, there's a lot of debate whether inflation is going to be sustainable at a higher level. I personally, I'm in agreement with Steen, but we have to look also at the deeper level, which prices are rising and how is the economy responding. And we have new industries which definitely are responding to inflation at a higher rate. So for example, if just one example is non-fungible tokens, right? So we've seen a huge explosion of these digital assets which are basically unlimited in supply. They can be produced at no cost, and their prices have skyrocketed. So we're seeing asset price inflation. That's just one example. We're seeing other segments of the economy not experiencing such high inflation, while financial assets especially have been experiencing inflation since the global financial crisis, post-global financial crisis. So that's just my take. We need to look at the way the structure of the economy is going to change in response to policy.
Thanks, Matt. Okay. Steen? You are muted, Steen.
So in the short term, is everything that went down is going to go up. So the leisure industry, the shipping, the restaurants, but I don't think that's really relevant. I think we need to understand that every 50 years, the world resets. The last time we reset was in the 1970s. We opened up to China. We left the gold standard. We made a lot of the international organization that is in place today. We started the whole green environmental, Greenpeace was born at that time, atomic power, all that. I think this is exactly the same. This is a resetting of the economy. What is extremely positive is that right now, quality and tangible assets are outperforming junk and bullshit. Basically, today, the crypto space got whacked 25% down. And to be honest, I'm long. I believe in the optionality of cryptocurrencies from a technology and an optionality point. But the case here is that you need to understand, as a private citizen, as the business person, this is 1 in a 50-year reset of the economy. And that economy is driven entirely politically by more state intervention, state ideas about infrastructure, green transformation, and social inequality. So whatever we do, the winners will be people who own tangible assets, people who live in the real world, not in the virtual world. It will be, I think, and I hope socially, that we're going to engage more, talk nicer to each other, have some sort of rule on the internet of what crap you can put out there. But ultimately, it's about where the demand and supply is off. And that is in shipping, it's in commodities, base metals, it's in good service, it is in personal touch, it is in the ability to navigate and understand the rising group of people in the world, which is the Generation Z, the millennials. They are going to be the voters that takes the Green Party into power in Germany. So 1 in a 50-year transformation, but it's all good because my generation is the worst generation in managing the future ever, because we basically had lower interest, lower inflation every single year. Now it's a two-way street. It looks good. It looks good for everyone participating on this call today, because basically we have a chance for having the best person in the room getting the most expensive order.
Thanks a lot, Steve, for the insights and also for the positive feel to the future of markets and the economies. We hope to be seeing you, maybe not personally, but in CNBC or other Bloomberg exchanges going forward. So thank you very much, Steve, for joining us and for finding the time. Kevin, I give you the floor to conclude.
Thank you. So yes, we are in fact running 5-6 minutes late. I will do nothing else except thank you, Mark, Victoria, everybody in your team at Bank of Valletta for collaborating with us today. I think this was an excellent webinar. Look forward to the next one. Look forward to more cooperation between the MMF and Bank of Valletta. I thank also Mr. Steen Jacobsen and all his team at Saxo Bank. Thank you very much for your enlightening contributions with us today. We look forward to plenty more together. I thank everybody who has been on this call. Thank you very much for your support and have a pleasant afternoon. Thank you very much.
Thank you.
Thank you, everyone. Bye-bye. Keep well.
Thank you.
Thank you.
Thank you.
Thank you.